The honorable student, you are welcome to class again. In this class, capital budgeting is our watchword. And we are starting by asking ourselves what we mean by capital budgeting. Capital budgeting, according to what you are looking at on your screen, is a process a business undertakes to evaluate potential major projects or investment. So, construction of a known plant or a big investment is an outside venture with a sample of projects that will require capital budgeting before they are actually approved. That is what we mean by capital budgeting. Now, what is our understanding regarding this concept? Ideally, businesses will pursue any or all projects and opportunity that enhance shareholders' values and profit. However, because the amount of capital or money any business has available for new projects is always limited, you never have enough. Because of this limitation on the capital available to the business, management use capital budgeting techniques to determine which project will yield the best return over an applicable period. And the one that added more value to the shareholders' wealth is one the management will select. Although there are numerous capital budgeting methods, we try to look at few of these that company can use in undergoing their businesses. What are the techniques we have? We have some techniques that could be used in carrying out capital budgeting. One of it is payback period. We have discounted cash flow. We have payback period. We have discounted payback period. We have net present value. We have accounting rate of return. We have internal rate of return. And we have profitability index. These are the different types of techniques we have in carrying out capital budgeting. We pick an example and we run through all these types or techniques in it. Let's go. The example we have on the screen says ABC Incorporation is planning to buy machine A, which will cost 10 million. Please note all this. It equals what? 10 million. The expected life of the machine is 5 years. Is what? Is 5 years. The salvage value of the machine is nothing, which is nil. ABC Incorporation is expected cash flow of $5 million for the first 2 years, 3 million for the next 2 years, and 2 million in 50 year rather. So operating expenses is $1 million for every year. Discounted rate is 10%. Assume there is no tax. And now let's find out the answer by using the different techniques we have. The first one is payback period. You can see, according to the question, there we have 5 periods. 1, 2, 3, 4, 5. That is 5 years. The revenue in the first 2 years we are said to be what? To be $5 million each. For the next 3 years is $3 million, and the last year is $2 million. And we are told that operating cost is $1 million each. Now, what is the profit? Let's find out the profit first. The profit in the first year is $4 million. In the next or second year is another $4 million. In the third year, it has reduced to $2. That is 1 minus 3 revenue, $1 million or $3 million minus $1 million, which is revenue, giving us $2 million. The same thing we have it throughout. And you know, it is payback period we want to calculate. We need to accumulate this. And the year it falls, or the period it falls, where we can make up the money we spent on the machine is the year the payback period will be. Now, what is the amount required for the business? We have said that the machine will cost $10 million. You remember in the question is what? Is $10 million. Now, if it is $10 million, when will our income give us $10 million? Please, we are not dealing with revenue here really, but the cumulated profit. Understand? You can see in the first year we make $4 million profit. This is it. In second year we make another 4. It accumulated to 8, and the last year we make 2. It accumulated to 10. It means that our payback period is equal to 3 years. So by the end of the third year, we'll have made what we used to start the business. This is how payback period actually operates. Traditional payback period. Now, we have discounted payback period. Let's see how it goes. For discounted payback period, the same thing will go up to the profit. But before we start accumulation, we discount the profit. And we are told that the discount factor is 10%. So the 10% in the first year is 0.901, second year is 0.824, third year is 0.7513, fourth year is 0.6830, and the last year is 0.6209. Understand? If that is the case, what's our discounted cash flow? 0.039 multiplied by $4 million give us 3.6. This one multiplied by 5 again give us 3.3. This one by 2 give us this. Up to the last it give us. So the next thing we need to do is to now start accumulating the discounted cash flow. This is 3.3,630,something thereabout. No, it is a million. So accumulation, we accumulate this because nil is here. Second year we add this to the first year discounted profit. It becomes 6. This plus this give us 6. This will also give us 8. This give us 9, and we also add this to this one. It give us what? 10. It means that if we use discounted payback period, we make our money back at what? At the end of 5th year. That is a discounted payback period. And this method is the same as payback period, only that we discounted our cash flow. And if you want to actually calculate when it is going to be, because we have some noises here, look at this, and it is 10 million exactly we want. So we can also do some arithmetic to calculate there. And how we go? Just look up here. Look at my pen. What we do is that, after 4 years plus, what is the difference between, or what is the excess of 10 million we have? It is 0.4315. Is that okay? Let me do it this way. Let me do it in this format. Let me do it in this format so you can get it better. What happened is this. This is 4th year and this is 5th year. Remove 9.81. 9.8106 from 10 million. What it will give you, multiply by 52 weeks or multiply by 365 days. It depends on the one you want to use. If you want to use days, use the 365. If you want to use week, use 52 weeks. If you want to use month, use 12. So, we count up to 4. That is 4 months. 4 years. And the balance weeks that will give us before we can make our 10 million will be 10 million minus 9.8106 multiplied by 52 weeks or 365 days or 12 months. It depends on the rate as you want to calculate the period. Is it at daily rate, at monthly rate, or at weekly rate? That is, you want to find out the rest. And if you do it properly, you see that it takes approximately 4 years 16 weeks, that is 4 years 4 months to recoup the money. It takes 4 years 4 months if you use 12, or 4 years 16 weeks if you use weeks, or if it's days you use, it's 4 years 16 weeks times 16 times 7. That's the number of days you will have. That is how it is done. I hope you understood that regarding discounted paper period. The next one is net present value. Let's also see the practicability of this. MPV is one of the most commonly used method for investment appraisal techniques, and it is the sum of the discounted cash flow less the initial investment. So the amount, if it is possible, will be if it is positive, if the balance we have is positive, we will accept the project, and if it's negative, we will reject the project. And in our hypothetical example, our discounted cash flow is 10.4315. So 10 million, 10 point, let me write the model first. Net present value is equal to present value minus cost, or we call it initial outlay. If that is the case, our present value is 10 million 4315 minus 10 million. So it gives us 4315. And let me say $0.4315. So our MPV is positive. The machine or the investment is supposed to be accepted. That's our MPV. It's just like that. And after the MPV, we have accounting rate of return.